Hi everyone, welcome to my channel. In today's class, we'll solve problem on marginal costing. In previous video, we have studied the formulas relating to calculation of contribution, profit, PV ratio, BEP, and margin of safety. If you want detailed notes on all these topics, please check in playlist. Let's start the problem number 1. You are given the following data year 1980 and 1981. In 1980, sales is rupees 1,20,000 and profit rupees 8,000. In 1981, sales is rupees 1,40,000 and profit amount is rupees 13,000. Find out PV ratio, BEP, that is break-even point, and profit when the sales are rupees 1,80,000. Next, sales required to earn a profit of rupees 12,000. And the last one is margin of safety in 1981. So here we have to find out five things. That is PV ratio, BEP, profit when the sales are rupees 1,80,000 and sales to earn a profit of rupees 12,000, and the last one is margin of safety in 1981. Okay, let's start the solution. Solution. First, we have to find out PV ratio. Right here, number one, PV ratio. So whatever information they have given, write down here. That is year 1980 and 1981. Sales in 1980, sales is 1,20,000 and in 1981, 1,40,000. Profit in 1980, 8,000 and in 1981, 13,000. So in 1980, sales is rupees 1,20,000 and in 1981, sales is rupees 1,40,000. So difference amount is 20,000. And same for profit. From 13,000 minus 8,000, the difference amount is 5,000. This is called change in sales and profit. Change in sales is rupees 20,000 and change in profit is 5,000. Write the formula to calculate PV ratio, that is change in profits divided by change in sales. This formula we have to apply here. Okay, because they have given information related to sales and profit. So write PV ratio is equal to change in profits divided by change in sales. Change in profits, that is 5,000. Write the difference amount 5,000. Change in sales, that is 20,000. Do the calculation. 5,000 divided by 20,000, you will get 0.25. So this is the PV ratio. If you want this PV ratio in percentage, what we have to do? Or 0.25 into 100, 25%. PV ratio is 0.25 or 25%. Next, we have to find out fixed cost and contribution. Okay, to calculate BEP, for that we require fixed cost and contribution. To calculate fixed cost, the formula is contribution minus profit. Okay, fixed cost is equal to contribution minus profit. So contribution is not given in the problem. So first we have to calculate. First we have to calculate contribution. So the formula to calculate contribution is equal to sales into PV ratio. Sales amount, we will take this one 1980s, that is 1,20,000 into PV ratio 25%, or you can write 0.25. Okay, if you take 25% also, you will get the same amount, and if you take 0.5 also, same. So sales will take 1,20,000 and PV ratio is 25%. Do the calculation. 1,20,000 into 25%. So what you have to do, 25 divided by 100, or directly you can calculate 25%. You will get 30,000. 1,20,000 into 25%, that is 30,000. This is the contribution. So we have got contribution right here. Fixed cost is equal to contribution minus profit. Contribution is 30,000 minus profit. So we have taken information related to 1980. That is 1,20,000 is the sales, and same year the profit amount is 8,000. So right here 8,000. From 30,000 minus 8,000 you will get 22,000. I have taken information related to 1980. If you take information related to 1981, you will get the same fixed cost amount, that is 22,000. In place of 1,20,000, if you take 1,40,000 into 25%, you will get 35,000. Okay. And to calculate this fixed cost contribution, if you take 35,000 and from that minus profit amount, in 1981 the profit amount is 30,000. So how much you'll get? Say 22,000 fixed cost. Okay, from 35,000 minus 13,000. Next we'll calculate BEP, that is break even point. Second one, BEP. So to calculate BEP, the formula is fixed cost divided by PV ratio. Fixed cost just we have calculated, that is 22,000 divided by PV ratio, that is 25%. Okay, in place of 25% you can take 0.25 also. Okay, do the calculation. 22,000 divided by 25%, you will get 88,000. This is the BEP, break even point. Third one is profit when the sales are rupees 1,80,000. So we have to calculate profit when the sales amount is 1,80,000. Profit is equal to contribution minus fixed cost. Here the sales amount is 1,80,000. So again we have to calculate contribution. So the formula to calculate contribution is equal to sales into PV ratio. Sales amount will take 1,80,000 given in the third point into PV ratio, that is say 25%. 1,80,000 into 25%, 45,000. Contribution is 45,000 minus fixed cost. Fixed cost is same, that is 22,000. 23,000. This is the profit. Profit amount when the sales are rupees 1,80,000. Fourth one is sales required to earn a profit of rupees 12,000. In fourth point, we have to find out the sales value to earn a profit of rupees 12,000. Sales required to earn a profit of rupees 12,000. And the formula is sales volume required is equal to fixed cost plus profit, or you can write plus desired profit divided by PV ratio. Fixed cost plus profit divided by PV ratio. Fixed cost is same, that is 22,000, which we have already calculated. Profit is, that is given in problem, that is 4.12,000. Okay, this profit we have to take 12,000 divided by PV ratio, that is 25%. Do the calculation plus add this figure 22 plus 22,000 plus 12,000 and divide it by 25%. You will get 1,36,000. So sales volume required The answer is 1,36,000. Next is last one. Margin of safety in 1981. Fifth point. Margin of safety in 1981. Formula to calculate margin of safety is actual sales minus break-even sales. Actual sales. The problem in 1981, the sales amount is 1,40,000. In 1981, sales amount is 1,40,000. Break-even sales 88,000. 88,000. From 1,40,000 minus 88,000, you will get 52,000. This is the margin of safety. Margin of safety in 1981 is 52,000. Got the solution? If you have any doubts, please write in comment. Please subscribe my channel and share with your friends. Thank you everyone.